Hey guys, Krolak here of MNT Academy. Today we're going over the reported liquidations indicator, which gives us direct information about traders getting liquidated in the market. Let's get into it. In this video, we'll discuss how to set up the indicator and also go over what replics are and why do they happen. We'll also cover how it relates to the regular volume indicator and how you can use it as a confluence in your own trading system. So jumping into the terminal, we've got our default chart. And to add reported liquidations to our chart, we can go Indicators, MNT Official, and if we click Liquidations, it will add the reported liquidations indicator to our chart. For this video, I'm going to utilize the power of MNT's custom scripting engine and use a community-created script. So if I click Indicators again and go to Community, I can see the custom community scripts, and if I type in lick, I can select the aggregated liquidations indicator made by an MNT community member and apply it to the terminal. And I'll quickly clean it up a bit, but this indicator is now aggregating liquidations across the multitude of exchanges. So what is a liquidation? A liquidation is when a trader essentially runs out of money on their trading account. So if they're trading on an exchange such as Bybit or Binance, and they run out of money on their trade, or they lose all their margin, they're not allowed to go into debt. So what the exchange does is once their account hits zero, it forcibly exits their position for them at market. So for example, when we came down here, for instance, you can see that big spike in volume, and a large part of why that spike in volume occurred is due to bulls getting liquidated. So you can see this candle is pointing downwards and it's green. So this is indicating market selling from bulls getting liquidated. It's not the same thing as a stop loss. A stop loss is when a trader willingly exits a trade or gets stopped out. A liquidation is an involuntary stop loss, so you can kind of think of it as. So if I turn on the liquidity heat map for a moment, which you guys should be familiar with now, we can see an example of a lot of liquidity down here. So when we started moving down and liquidating a lot of players on the bull side, so these are bulls getting liquidated, big spike in reported volume per candle down here, and this is them being forced to sell. And then on the flip side, you'll notice that once we started uptrending, we're getting reported spikes and liquidations, but this time it's from bears. So we're going up, some shorts are running out of money, and they're being forcibly liquidated by the exchange and forced to buy. Hence the spike in these red candles to illustrate bears that are buying. So these are bears that are getting liquidated with lots of volume transacted. And we can notice that if we go to a slightly higher time frame, we're now approaching a liquidity zone where there's plenty of stop loss liquidity and liquidation points, and we should see a large spike in reported liquidations once we go into this region. So how do we utilize reported liquidations? Well, if you watched my video on exhaustive volume, you'll understand that when the market has more explosive breakouts or reversals, it often coincides with a big spike in relative volume. And you can use aggregated liquidations as a confluence for this. So oftentimes when the market gets a spike in reported liquidations, that often coincides with reversal points or breakout points. So you can think of it as an additional confirmational element to your existing volume analysis. So you might be wondering, if reported liquidations are so similar and so correlated to regular volume candles, what's the point of it? And that's a good question. Whenever liquidations are occurring, there is always going to be volume transacted, because as people are getting liquidated, they're forcibly stopped out. That's market orders being transacted, and this volume is being transacted. So it's one directional in that sense, but it doesn't necessarily go the other way. For instance, here we had a spike in volume as price shot up, but it does not necessarily mean people are getting liquidated. This could be people entering or stop losses or exiting at market, but it does not necessarily mean that the move up was driven by bears getting liquidated. So volume does not necessarily mean liquidations, but liquidations necessarily means volume. And so ideally, whenever you're looking for some sort of play, you want to see both of these factors align. You want to see that exhaustive volume being transacted, and you want to see some meaningful relative spike in reported liquidations, such as these examples here and these examples here. And if you backtest this, you're looking for the regions and reversals and breakouts where these two indicators align. And that's when you're going to get your highest probability trades, because the market, as we discussed in prior videos, is looking for those exhaustive wipeouts before it does reversals or breakouts. And a lot of traders are also looking for large spikes in reported liquidations to execute their trades. So if you backtest this indicator in combination of regular volume and price action, you'll observe lots of instances that when these indicators do align with spikes in volume, it often correlates with important pivotal structural changes in the market. Like any indicator, you don't really want to be using reported liquidations by itself. You probably can because it has plenty of edge to it. It's just these indicators are much better when you holistically combine them. So if you saw my video on confluence, you understand a bit better about how you can combine other technical factors such as order books or liquidity, volume, and price action analysis in order to identify when these different indicators align together so you can take more informed and effective trades. In regards to configuring the indicator, there's not much to do. In the settings menu, you can leave them aggregated. You can choose if you want it to display it as the dollar or the coin value. You can change the colors. Personally, I prefer it on an invert scale because it's more intuitive to me in terms of its directionality. And if you like, you can turn on the threshold. So if the liquidations exceed a certain cutoff, you can use that as a signal to potentially take trades. In conclusion, reported liquidations reveal when the market is forcibly closing leverage positions, creating pure one-directional pressure through involuntary market orders. While every liquidation generates volume, most volume spikes are not driven by liquidations, making liquidation data a less common and more meaningful subset of volume. The most powerful setups occur when a large exhaustive volume spike aligns with a sharp reported liquidation spike at a known liquidity or stop-loss cluster. Downward green liquidation candles signal long liquidations, so forced market selling, while upward red liquidation candles indicate short liquidations, so forced market buying. Used in isolation, it already carries edge, but combined with volume profile, liquidity heat maps, price action structure, or other technical indicators, it becomes one of the strongest confluence tools for spotting reversals and confirmed breakouts. This has been Krolak with MMT Academy. Thank you for watching this video on reported liquidations, and if you have any questions about this indicator, come on over to the MMT Academy Discord. I would be happy to hear them. Cheers.